Hello traders, Gary Wagner here. It is 11 o'clock in Honolulu, 5 o'clock in New York on Tuesday, 19th day of March, 2024, and this is the evening report for gold and silver. Traders, it is Fed Day, meaning the FOMC meeting began today, but it's tomorrow when it concludes. The dot plot is released, and of course, the statement and Powell's standard press conference that will set into motion where gold and, in fact, many of the financials go from here. Currently, it is after 12 noon here, 6 in New York, and we have gold reopened and trading in Australia, up $1.60 from New York's close at $2,161.30. And traders, it has to be noted that any move in gold, silver, anything that's paired against the dollar worked against the current today. The dollar was stronger today, up about 0.25%, 0.24%, and yet gold fell nominally and is currently trading overseas up a little bit, holding well. The question is whether or not it will become exceedingly volatile, even if gold moves higher tomorrow, because our stop is not that far from current pricing, but we'll see what happens. The dollar is up. The index is fixed at 103.485. Lastly, silver, we went long our current trade at $25.46.5. It is currently at $25.37.5. So it is currently a little bit lower than our entry price, but nowhere near our stop. Maintain your stop at $24.39 in silver. Traders, we are looking at a 4-hour candlestick chart of gold. By no means are we out of the woods. We came within 20 cents of our stop being executed. That, to me, honestly, is too close for comfort. Nonetheless, I have identified a basic Western pattern called a bullish flag or just a bull flag. I've just put on a sample of a bullish flag. And as you can see on this image that I've put on, it starts with the pole, which is basically a parabolic move up. And then it's created by two parallel lines in which the price moves from the high to the low on a couple of occasions, and then inevitably breaks to the upside. If it breaks to the downside, it's called a failure, but nonetheless, this is a prime example of a bull flag. The last chart that I want to take a look at is a daily candlestick chart of gold futures. This is the continuous contract. I have done a basic Fibonacci extension. I start the extension from October the 3rd, the day that we really saw the first part of this whole rally. And this is when we had a flare up in Israel, took gold up to about $2,055, came down a little bit. And then we had this first of all-time new record highs. And that is this here at approximately 2152. And then I start the extension from 1998, the end of this correction. And what I want to show you is by doing the extension, you can see how support falls roughly at the 61.8% fib retracement at 2158. The high falls roughly at the 78.6% retracement because the all-time record high is 2003. You can see that tail goes right into it. I believe that there should not be a problem if gold returns to bullish momentum, and I believe that it could easily do that, to take this out on a closing basis with the real brass ring above 2,200 at $2,255. That would be a 1-to-1 relationship between this rally here and the rally we are currently in. The following is my recommendations in terms of our silver trade. Maintain your current long position, maintain your stop. We will look to move that up once we see that the falling price in silver has stabilized. As far as gold goes, we are close. We did not get stopped out, But nonetheless, we don't have a huge spread between $2,149 and $2,161. My hope is that whatever the Fed says tomorrow, it will be construed as dovish or bullish for gold, taking the market up. My concern is that anytime Powell holds a press conference, we see an increase in volatility. Those that would want to relax their stop from 49 to 40 can go ahead and do so officially. I'm not going to lower a stop. I typically don't do that. So maintain your current long in gold as well as your current stop. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow, Fed Day, for the next daily update and review. Bye-bye.